Resolve Riffs. Bradley Barrie and Matt O'Brien join us today, and they say no man should fear any market. So no man should fear any market, Brad. What do you mean? Tell us more.
Yeah, thanks again for having us. Again, it's a pleasure and it's an honor. So we don't think people should fear the market. We think people should prepare for the market, kind of regardless of what happens. We're not big on predicting. You know, it's we don't have a crystal ball. For those that watched the last Resolve Riff that I was on, I mentioned that occasionally some people call me and ask, "What's Jerome Powell going to do?" And I kind of jokingly said, you guys might remember, I said, "Oh, I know Jerome Powell. He's, you know, I actually call him once a week, and he's yet to answer my call." Right? That was the punchline, the joke. But it's kind of a silly question, right? Like today's a core example, right? Jerome Powell talked today. I know this is being recorded on Thursday and aired on Friday, but Jay Powell talked today, and if you track the market today, it was up, down, and I think we finished down, right? So it's a matter of, even if you predicted what Jay Powell was going to say, could you predict how the market was going to react to what Jay Powell said? And we think the much better approach is you prepare by having appropriately diversified investments in portfolios, and that means utilizing alternatives. It means, as you show on one of your websites, the two-legged stool is sadly a solution that a lot of investors and a lot of advisors have followed, and it's worked for quite a while until it doesn't, right? And we believe in true diversification. We believe in preparing and not being afraid of the market. And if anything, that lets you kind of take advantage of opportunities as they transpire. So that's what we'll dive into today.
An ounce of prevention's worth a pound of cure, as they say. So how do you think through the actual diversity? So I always kind of refer to a bit of a three-step process, which is thinking about what are your diversifiers. So you've got asset classes that can diversify. You've got strategies that can diversify. You've got to think about how you would appropriately balance those, and then how you might rebalance those, and then how do those respond in various liquidity cascades or crunches. So how do you guys think through that as an OCIO in constructing a portfolio, thinking through the layers of potential diversifiers that you have, how they might come to inject different return streams and opportunities? Like, how do you think about that from start to beginning? Let's try and give folks, step one, asset classes, step two, strategies maybe, or share with me your protocol.
Yeah, I think, and Matt can jump in too. I think it starts with our philosophy, right? Everything starts with an overarching philosophy, and we believe having not just asset classes. That's where a lot of folks only look at is the asset class. And one of our other team members, partners, worked for NASA for a period of time, and he tells a great story about working at NASA and solving the right problems. And I don't think I told this story last time, but back when the space race was going on and they were trying to figure out how to get men up to space and men back down to space, they were trying to figure out how do you make this capsule that comes back down to space indestructible, right? Make this capsule that comes back into space, through space, back to Earth, indestructible. And NASA scientists, they couldn't figure it out. They just couldn't create indestructible material to go through the heat. So the way I tell the story, I say some guy in the back of the room raises his hand, says, "Hey, wait a minute, we're solving the wrong problem. We don't need to create an indestructible material. We need to create a material, or not even that, we need to get the astronauts back alive. So that's the problem, not creating an indestructible material." So then
asking a different question, attacking the problem from a different angle.
Exactly. Right. They were asking the wrong question. They were solving the wrong problem. So what they did was they created a bladed material that would basically self-sacrifice, right? And it would land back, and it would last long enough to keep the astronauts alive. So we think asset allocation, investing model portfolios is the same thing, right? It's not a matter of what's the best stock, what's the best bond, what's the best stock manager, what's the best bond manager. That can certainly play a role in it, but it's also what are the diversifiers, right? Asset classes is one, strategies is another, methodology is another. Do you follow a quant methodology and let algos solve everything? Do you use a fundamental approach and just use hunches, or use fundamental research, or do you use technical analysis with moving averages and Fibonacci's and everything else? Our approach is multidimensional. That's what we've coined it, because we don't believe one thing has the answer all the time, right? I like to tell the story that fundamental managers can be early to the party and quant managers can kind of be late to the party, right? Because the quant needs all the data in there first and crunch it and then realize what to do. And your fundamental manager can, they go by hunch sometimes, or they look at the research, or, I tell the Peter Lynch story when he walked into Walmart, 40 years ago and said, hey, this store's got something going on, right? And bought Walmart stock. A quant manager back then probably wouldn't have done that. I mean, a quant manager back 40 years ago was also probably working on like a 386 PC or something. Our
Let's
iPhone.
hope we had the math coprocessor.
Let's hope so.
But back to your question, Mike, about asset classes, right? Like, yeah. We think when we're thinking about just diversifying at the asset class level, like you're really just having a basic discussion, right? And you're just saying, I'm just going to take pure base from these asset classes, average, to assume these correlations hold. And I think one of the things that's been troubling the last couple of years for a lot of people that have been invested in 60-40 is that the correlations between stocks and bonds haven't held from what they'd been for the last 10 years, right? So we can't just rely on what correlations have been, because, based on the regime, if you're high growth, high inflation, high growth, low inflation, low growth, low inflation, whatever might have a different for those correlations. And that's taking out any idiosyncratic things that might happen in the meantime. So when it's almost as much strategy and philosophy of the investor. And I think earlier we think of them as return streams, because a high yield, there's two high yield funds we use. One, which looks nothing like a high yield fund whatsoever, because they're buying cigarette butts and just taking the last couple of coupons off and getting that steady carry. Another one that's very tactical, and that's in and out of the market, right? So those are two very different in the same asset class and have very, very different risk reward profiles. To us, as long as we can find those types of strategies, those low correlations to each other, provide some correlational benefit, and have some positive long-term returns or prospects for positive returns, it's all additive to us. So we try not to take a position, and that's why what we were talking about earlier, we try and predict, we try and prepare. Being prepared for high inflation for the last 15 years hasn't paid, so it can be painful at times, and there is sometimes a cost to some of this stuff, but we think that that's a small price to pay for avoiding being blindsided by the last 3 years of underperformance of bonds, right? It had happened before 3 straight years negative until it does, and you're completely taken aside. So if it's look, duration's great, interest rate sensitivity's fine. So like these are, but to what Brad said earlier, when the only thing you've got is equity risk and duration risk in your portfolio, there are times when those are correlated and you're going to feel pain. So it's beyond just the asset class. It's looking at the strategy, understanding how they relate to each other, and sort of building those together. It's a little bit of the grandmother tasting the sauce, right? You look at it a little bit, you see how two things work together, and try and build the I guess the most where you've got all your horses pulling in the same direction, even though they're doing it in very different ways.
I like what you're saying in terms of, I think we're circling the drain around the big question here. And so I wonder if we can pause and maybe take a step back, because I know that we're going to touch on a bunch of aspects of the strategy that you guys just launched, and talk about some of the other strategies that you guys bring into your models and how you attack that problem. But maybe it's useful for us to take a step back and say, what problem are you guys actually trying to solve? I think it's a similar problem to what we at Resolve are trying to do with our strategies, but it's useful to maybe frame the problem for the listeners here and anyone who's coming into this with fresh eyes and who hasn't necessarily bought into the idea that they should be doing something differently from their stock bond portfolio, but rather we can talk about the scenario as you guys see it and why it's important for people to be thinking outside the box, to be taking this multi-dimensional approach and embracing some fresh thinking on the problem. So maybe Matt, Brad, whoever can frame the problem for us. And
I think that's one of the uniquenesses that we bring to what we do and our experiences as both an OCIO and now portfolio manager for a mutual fund. You know, I talked more about it at the previous podcast I did with you guys, but I spent 20 years as a financial advisor sitting across the table from investors, from retail investors, individual mom and pops, wonderful people. And risk viewed by an investor is completely, I shouldn't say completely, but is a different version of risk versus a CFA in a tower with 4 monitors around them, right? So the problem we try to solve is how do you get to a smoother return experience, right? Everybody would love to maximize returns, but sometimes that means you're on a roller coaster. So what we attempt to do is to create the smoothest return experience possible, because that's how investors will stay invested, and it'll be a more pleasurable experience with the investor and thus the advisor as well. So we're trying to really minimize the drawdowns, the downside. And, one of the things that I'll beat the drum forever on, and again, I think that a lot of folks miss the wrong question again, is risk, right? I say all the time, standard deviation is not a measure of risk. It's how our industry defines risk, but standard deviation is a measure of total deviation, right? And in 20 years of managing money for clients, I never once met a client that didn't want deviation on the upside, right? Everybody wants deviation on the downside, not on the upside. I mean, they don't want deviation on the downside. So investors want deviation on the upside. So why do we measure total standard deviation? It doesn't make sense. So we break it down between gain deviation and loss deviation and attempt to minimize loss deviation through the use of non-correlated investments, multiple strategies that can be complementary towards each other. Matt was talking about the bond market, and bond market as a diversifier the last 3 years, it hasn't really worked, right? Correlation has been so strong. And I mean, we talk about fear no market, right? We're near Halloween. And if you want to get scared, look at the bond market this year, right? And it's so funny because, it's so funny because at the end of last year, everything I was hearing was, the bond market, now's the time to buy bonds because bonds have never been down for 3 years in a row, right? And it's like, and I've heard someone else say stuff that has never happened happens every day, right? And if you look at the bond market this year, the market's not over and bonds could still end up. But you look at the volatility of bonds, and anyone out there, we have charts of it. But if you look at, just the daily change of bond index this year, I mean, it's seesawed. The bonds were up 4% in January, down 4% in February, up 2.5% in March, bumpy flat, right? And if you're watching this and looking at the numbers, don't hold me to all those numbers exactly, right? This is just estimates, but it's been anything but conservative, and that's not what investors really want. And we think you can reduce risk and with more than just 2 asset classes, and in the long run benefit from that diversification. And when we talk about the mutual fund and the strategy behind that, our firm is named Dynamic Alpha Solutions as the OCIO, where Dynamic Wealth Group is the main parent company, and the fund is called Dynamic Alpha Macro Fund. And Dynamic Alpha is our version of rebalancing alpha that you guys I know have talked about, right? Being dynamic and being able to rebalance between the two, and thus create the alpha to kind of reduce the risk. That's what we strive to do in our fund as well as the OCIO. Go ahead, Matt.
Yeah, no, I hate to interrupt because we're getting down the rabbit hole, and I just want to go back to the question there, right? Like, just to summarize what Brad's saying, like at the front end is like, so much of our industry and the investors that I've dealt with over the years, right, is so focused on relative return to the indices. And what really at the end of the day, their number one goal should be is helping their clients achieve their goals. A part of that is being competitive so they stick with you and they're not poached by someone else that's pitching better returns, better downside credit, whatever it might be, right? So what we want to try and do with these diversified portfolios is narrow the range of outcomes, right? Eliminate those big down years that could potentially blow up a financial plan. And so if the cost of that's a little bit of the upside, that's fine as long as we're able to achieve the goals of the client, whether that's a 7% growth rate they need for their 401k to grow over the next 15 years or 20 years to get them where they need to be, whether that's if they're in their income phase where they're taking out and making sure we're achieving the 4 or 5% they need to replenish their draw. That's really what we're trying to solve, is how do we allow advisors to build portfolios that really can be robust in any type of market environment. And look, Brad said it, the unknown can happen at any time. And we have a limited set of tools that we have at our use, right? In the public, I mean, we primarily deal in the public investment market. So there's more certainly in the private markets, but we can prepare for a lot of different environments that have historically brought themselves to bear on client portfolios with the tools that we have. And that's really what we're trying to do at the end of the day. So it's just taking that range of outcomes from here and just narrowing it down a little bit so that it's a more manageable return stream for the client.
Yeah. And I have a quote on that, and I want to take full credit for it. Because the future holds what the past has yet to reveal. That happens over and over again. That is me. Just so we're clear, I don't want any ambiguity. I didn't steal it from anybody. I lived it, and then I figured out words to articulate it. It doesn't have a lot of fat. It summarizes it well. We experience it every day. The future holds what the past is yet to reveal, and that is in every form of innovation possible. It's every form of surprise possible. Things are happening on a regular basis that haven't happened before. The fact that we have negative returns on a 5-year on bonds hasn't happened before. Doesn't mean it was never going to happen. Mm-hmm. Like that's the preparation over prediction. And yeah, it's not easy. It's not easy. Let's think about capital allocation between stocks and bonds of 50-50. Does that equate the risk? What about inflationary periods? And by the way, that was a rhetorical question. No, it does not equate the risk. If we wanted to equate the risk, we'd put 15% in stocks and 85% in bonds. That would equate the risk. But even that ratio changes regularly. But what if we wanted to add a third asset class and we wanted to maximize the diversification opportunity of these three bodies? It's a three-body problem. It's not solvable. It's only dynamically solvable based on the observations we're having in the current moment. Most people are like, oh, it's too complicated, can't do it. Well, then suffer the slings and arrows of large, prolonged drawdowns, suffer the slings and arrows of how that affects the withdrawal rate and sustainability of the withdrawal rate if you're an individual or an endowment or anyone who has a portfolio in accumulation. It's easy. You're going to eat the lower distributions of the portfolio, the lower lifestyle, the lower funding of educational programs. And it seems to be okay when we eat it ourselves, but it's not if we're going to hold ourselves to a fiduciary standard, which means that we as OCIOs are capable of and understand these processes and more and should be trusted in a fiduciary role. We put these forward. But it's funny how boards will reject them. I think benchmarking is an extremely dangerous, ubiquitous thing that impacts all people. These are really hard problems, and I lay this at our feet to try and help people understand that the problem is not easy. And when it seems like you've got a dynamic, complex problem like this solved, you should realize immediately that you have some challenges, right? So I put that back to you guys. How we help people with this.
You said a few things that resonate so strongly. I think. I mean, first off, you're right. Volatility when you're accumulating money is actually helpful to you, but when you're in the distribution phase of life, volatility can totally destroy you, right? So having more diversification during that distribution phase is crucial, especially now with inflation being higher, right? And The other thing that, benchmarking, we could probably spend 4 hours just on benchmarking. And again, from a retail investor standpoint, which is what 20 years of my experience is benchmarking is done, and everybody benchmarks to either the S&P or the aggregate bond index and track those two things. But, and I know I talked about this in the last podcast, absolute return versus relative return. A very important concept for investors and advisors to understand, because if you're targeting a relative return and you lose 20% when the market loses 21%, you might be ringing the bell thinking you did a fantastic job. If you're a large cap core manager and that's your bogey, but your end investors are not happy losing 20%, right? They want to have the manager to have flexibility and to be able to be different, right? And Matt and I were talking about this earlier today, and there was a presentation we saw a number of months ago, and it was about alternative, and the person doing the presentation basically said, well, the risk of doing alternatives is your tracking error is going to be bad, and you don't want a bad tracking error, so you don't want to use alternatives. And I sat there scratching my head saying, so what are you talking about? You don't want diversification? It's if your tracking error is to track the S&P or track a 60/40, just buy the 60/40. It's pretty simple, right? But
I'll take tracking error against the 60/40 over the last 2 years.
Are you kidding me? Peak
But recency
60/40.
bias. But think about the last 40 years and how long. And then you had a year like 2022 when it was kind of like what most alternative managers would have thought would have been the staple year to prove the point, right? It really was a proof of concept. And you start 2023 with mega cap ripping back higher, although the 40 portion of the portfolio is down. The 60 portion, especially if it's market cap weight, is ripping back up. So people are like, maybe 2022 was just a one-off. Maybe we don't need to really wonder about that. So I wonder, can you guys explain a little bit how the conversations with clients go? I mean, I would imagine to some degree, some of the clients that you guys have come to you because they embrace your investment approach. But I'm sure you guys have also to engage with clients that don't necessarily, maybe they don't want to do the homework, or maybe they're at the very high level, they know stocks, they know bonds, but they don't really know about alternatives. They don't really understand that they might need them. How do some of those conversations go, and what are some of the sticking points that you guys tend to face in those conversations?
So I think you brought up a couple of things there, and so the conversations go well. A lot of advisors at a high level are comfortable with the story, right? The story is we're going to give up a little bit of upside to make sure we're protecting on the downside. And so whether that's because they've been using some sort of tactical rotation strategy, or they've been using some option strategy or some other hedging strategy inside their portfolio, that like the high level story works, right? It's not foreign to them. The way we implement it may be foreign to them. And so sometimes that takes some hand holding, and our approach is, we're not crazy. We have a passive core that's cheap, easy beta access to stuff. And then we surround that by either high active share, traditional asset classes, or a whole bunch of alternative asset classes or return streams as we look at them. From different strategies. I come from like a value methodology. That's how I came up in the business. I came up in like 06 through 09, was sort of my formative education in the business. And, I'd looked at alternatives at the time as just commoditized. Managed futures is all the same. And the last few years of digging in there, you really realize how disparate this catch-all category of alternatives we've created is. And understanding that one guy runs a managed futures in X, and you guys have done a lot of good stuff on this, and I've heard a lot of people in this sort of ecosystem. I think Andrew was on with Corey not too recently, talking about differences in a couple of different managed future strategies. I think he and I forget the other gentleman's name run. But it's been such a learning curve, right? You can't necessarily compare apples to apples. You need to really understand what's going on below the surface. Or you just take it as, sort of a return stream. You look at that return stream, you analyze it, and you see what you think's most likely, how it'll fit best with what else is in your portfolio. So I think the implementation's tougher. And I think one of the things where we have a lot of traction is with advisors who have sort of taken out the line item discussions, right? They don't really talk to their clients so much about each of the individual positions in their portfolio. That's like an old brokerage way of doing things, right? It's because I got to sell something in the portfolio to buy something new so I can generate that commission and keep on chugging, right? If we're looking at it on an advisory basis in the RIA world, like at the end of the day, what matters is what overall the portfolio did and how that's helping the client get where they need to be. So if the advisor can keep those conversations at that level, it's a huge boon. And we're lucky. I mean, we work with a handful of groups and they're sort of at that point with their clients where they've built that level of trust and they are good there. And I think that's where I've seen these types of strategies fall apart, is because if you're looking individual and going through every line item in the portfolio, eventually it's likely that some of these alternatives will be underperforming at one time or another. And that's kind of by design. I mean, if everything's going up at once, you're really not all that diversified. I mean, you can't.
Precisely.
So we want to make sure that it's the conversation. It's we're not talking about all the different elements. Like, I don't know anything about car repair. So, the mechanic showing me what's going on with my transmission means nothing to me. It means absolutely nothing. My trust that this guy's been doing it for a guy who owns a car company around me, who owns a town car service, like that speaks more volumes to me about being comfortable with him and trusting it. So I think that's the type of relationship advisors really need to have with their clients, because if it's that old way of just going down the line, it's going to be a difficult conversation at some point.
And that's the relationship we have with our advisory firms that we work with too. It's very much a partnership, collaborative. Advisors are bombarded in multiple directions, growing their business, working with their clients, doing financial planning, examining estate planning, insurance planning, tax planning. A good advisor is solving a lot of problems for their clients, right? We come in, partner with the advisor, act as a CIO for them. We're an extension of their team. We do the heavy lifting for them on all the investments. We'll do one-off case analysis with them. And when they have this client come in and here's the problem they're trying to solve related to their investments, and create a customized solution for them if need be. And it's based on, again, our overall multidimensional philosophy based on true diversification, and is, as Matt said, kind of narrowing the expected range of returns, which is what investors want. But it's a very collaborative relationship with our advisors. We partner with them, and our goal is to help them be better advisors, and then they provide even better services to their end clients, which is what we're all here for.
When you're creating these solutions for advisors, I would imagine you guys have, given your general investment philosophy, you have a general approach, an investment framework, and then it gets somewhat tailored to the specific advisory groups. But I'm wondering, how are those portfolios constructed? Like, say if you had like an average portfolio that you could describe to us, would you have a bond, fixed income like bucket, an equity beta bucket, and then an alternative bucket? Or are you attacking this from first principles and saying, everything needs to be, from an absolute return basis, its own independent entity?
Yeah. No, we love, is 60-40 dead? We love 60-40. We have 60-40 in our model, right? That's the low cost beta exposure to stocks and bonds. And we use low cost ETFs for that, right? And then we'll have alternatives. It's sleeves, a sleeve approach, really, right? So we call it a strategic sleeve, which is stock, bond, low cost beta based on the risk tolerance. It will depend on whether it's 60-40, 80-20, 20-80. And then we have our alternative sleeves. And we like to say we look at the alternatives to alternatives. So, we're not just looking at real estate or private equity or BDCs or things like that, right? We're looking at, unique differentiators, unique risk reducers.
All not alternatives, by the way, just to be clear.
Yeah, you guys know that. That. Yeah. And
don't get us started on that one.
Yeah. One of the things that we do from a philosophical standpoint is we try to ask the question on each investment is, what is the return driver? What's going to drive the return of this investment? And is the driver of this investment similar to other drivers, right? And, if real estate is driven by global economic growth or the growth of the economy that's there, well, that's a similar driver as what's driving the growth of, an S&P 500 stock, right? So, you're not getting necessarily the diversification that you might be getting versus if you had, a trend following managed future strategy or a long short strategy or whatever, right? There's multiple. A merger arbitrage strategy, is a great alternative to a bond, potentially, and totally different drivers, because the return driver of a merger arb strategy is, does that merger go through or not go through? That there are a lot of mergers happening, is there not a lot of mergers happening? That's not necessarily impacted by credit or default risk of bonds. So, yeah, it's kind of a sleeve approach to answer your question, and we try to balance things. We'll try to have a quant manager with a fundamental manager. If we can find a good technical analysis manager, we use them as well, and have multiple strategies, multiple disciplines, kind of balancing each other out. And it's not because we can't decide which one we like better. That's not what it's about. It's we like them all, and that's the preparation over the predicting.
And how many buckets are we talking here?
It's really 3 buckets, right? So, and we've sort of changed the nomenclature a little bit because funds don't fit nice and neatly into buckets anymore, and we can get into a little bit too. But it's a strategic bucket that's just low cost, cheap beta, right? ETFs. That's going to make up 40-ish% of most portfolios. There'll be about 30% that's going to be in sort of high active share, active equity, fixed income managers, and at some blend depending upon their risk tolerance. And then 30 is going to be in something, investments that we consider alternatives. So whether that's your guys' fund, whether that's, another managed futures fund, a multi-asset strategy. Multi-asset strategies are where it gets a little weird because you've got the passive beta in there sort of included. Then you've got, a managed future strategy on top, or risk parity strategy on top, something that's a little bit different. So it's evolved a little bit, but that's the general idea. So that 40-30-30 is a baseline, but again, it's really, we start with a philosophy and we want to tailor that to what an advisor. So one of our teams, for example, wanted, let me go back a second. So part of the reason you have to add the beta in there is because the client base the client base our advisors work with, sort of the high net worth individuals, absolute return strategies sound real nice to them, but the reality of owning them is just not feasible for most high net worth individuals. They succumb to the peer pressure of, oh, so-and-so did 20% this year and I only did 6, forgetting that last year they might have been down 15 and they were up 5, right? So any goodwill you get from that sort of goes out the window. And as we know, returns tend to be skewed to the upside. So over the long run, you get a lot less of those down 15 years than you do those up 10 or 15 years, especially recently. So
at least for the sample size that we have, again, right?
Correct.
It may be the case that we are in the throes of some kind of scenario inflection, some kind of shift in the paradigm, so to speak. It might not happen, but I mean, I think part of the challenge that we're all facing as managers, as allocators, is to contemplate, to paraphrase Mike's earlier point, right? What does the future hold, right? What is the problem that we could be facing, and how do we attack it from a first principles approach?
Yeah, definitely. But
I'm getting fired up. Keep going. But when I'm going to be like ultimate warring this thing. I'm getting so fired up. I'm trying to stay calm.
let's
keep going.
But advisors, the teams we work with, we're really lucky. The teams we work with are great and they're really collaborative. So we try and help them understand what risks are in their portfolio. So we could go out in the world and say they're at one of the custodians that has every investment option available to them, right? And we create the purest version of the model that we have. We can go through that with them, break down where their risk exposures are, understanding the ups and downs of the portfolio, where it might underperform, where it might outperform, and those things. And a lot of times we tweak it from there, right? They may say, in an up year, we need to participate a little bit more. So we need a little bit more of that beta in there rather than a little bit heavier the alternative. So we really want to be collaborative. We're not stodgy enough to say we've got it figured out. We think we have a really good philosophy that works. But again, I'm not Henry Ford. It's like you're not just getting black cars off the line, right? Like I'll give you the options that are out there. So
no, we have to.
With that, I'll let Mike go dig in on whatever he wants to get fired up.
Like we have to. We would like to stay in business, so we have to engage in what's called benchmarking.
Yeah.
It's benchmarking. It's not benchmarking. I gotta hold it back. I feel like I'm Dr. Heckle, Mr. Jiving Jekyll. I'm just like, So there's this
I know what you
whole
mean.
thing where we're like, what's the objective function of the client? As Bradley, you so succinctly outlined at the beginning, we're trying to achieve some financial goals. Do they have any relevance to what stocks and bonds do necessarily? Not really. They could, but now we've got to do some benchmarking because you have a bias between some tracking error from you and your buddies and some esoteric, falsely calculated benchmark nonsense.
Well, as soon
It
as you get the
happens
SEC
to
to say
have
we don't need
done
it.
well. Exactly.
Yeah.
Self-regulating organizations help regulate themselves via these means in order to conduct business. So this is an emergent phenomenon that comes from where and how the structure of the industry manifests. That does not mean that you have to buy into it. If you would prefer to go away from benchmarking and go to what you might want to achieve in your portfolios, which I think we're all trying to do in a way that's acceptable behaviorally, so people can stay disciplined and actually stick with it. But this is a objective function that we have to manage. That if we didn't have to manage, we'd probably do things differently, but we have to factor it in. And the funny thing is the benchmarking changes if you're talking to an advisor or investor in Texas versus if you're talking to one in Silicon Valley. Benchmarking is different.
Yeah.
Now, as professionals, these are things that we have to engage in because we have to know the client and we have to understand their vulnerabilities. But make no mistake, it's benchmarking.
I can't argue with that. I can't argue with it at all. And I guess from our perspective, from my perspective, I won't speak for Brad, but I'll speak from my perspective of, I think we need to push people in the right direction.
Yeah.
Without making it so uncomfortable that it's unownable or they shut you out like that, right? Like
Correct.
That's the sweet spot. And it's one of the things that I remember in 2011, I was running some model portfolios for a large OSJ that was with LPL at the time. And we had about 250 advisors across the country. We were running about 300 million for the firm. And our CIO comes out of nowhere and he's like, I want to add managed futures to the portfolio. Okay, 2011. All right. Okay. Let's talk about what that looks like, because we're getting pushback on, allocation funds that did phenomenal through 08, 09, right? And are lagging by like 3 and 4%, and we're getting hammered on those. And you want to introduce something that could by itself be down in a year where the market's up 20%. Like, do you know what my conversations with these advisors was like trying to fight that into the portfolio? And so part of how we build our portfolios on the OCIO side, and part of how the fund's structured is, it's hiding the vegetables, right? It's taking those Brussels sprouts and frying them up and putting something delicious on top of it, because by themselves they may be a little bit unpalatable. No one wants those boiled Brussels sprouts from childhood, right? You want the good stuff that's fried crispy and has something sweet on top. Like that's what you're looking for. And so by pairing a managed futures approach, a risk parity approach, or any of these different alternative strategies with just baseline beta ends up being a more palatable approach. Is it the pure play where you get all of the benefits of the non-correlation? No, it's not. But it does allow you to take out that line item risk I was talking about earlier, where you're not seeing a fund that's down 10% or down 5% when the market's up double digits, because historically that's more often the case than not. And you don't get paid for those 5 years in between before it pops.
Yeah, and we have to account for that physical pain. What manifests is physical pain and tracking error. So whilst I'm pushing the point on benchmarking, I'm adjusting a little bit, but my jest is far, far less. And it is a real thing that we have to deal with. We as the professionals who are helping those who are helping the others, the actual asset owners. These are real things that we're faced with as objective functions within decision making that are not purely economically functioning and not purely congruent with the academic literature. And they're perfectly valid, by the way, Matt. And I accept everything that you've said, and I say it's a hard yes.
Yeah.
But it turns benchmarking into benchmarking, and we have to realize that.
Yeah, I think it's like you're just constantly getting battered by the environment. Again, everyone on this call knows that every client that's watching any of the financial media is just getting hammered with the wrong stuff at every turn, right?
Yeah.
And so there has to just be some acceptance that as much as we're in that client's ear and as much trust as that advisor might have, you're in front of that client how often versus how long the television is on or CNN's on, or the quote of what the S&P 500 did is in their face versus.
And you have to factor in their attention span as well, right? So the way that you're delivering the message, how long it's taking you to actually get the message across, right? One of the things that we often comment here is that there's optimal from a math perspective, like a mathematical optimality, and then there's behavioral optimality, right? Understanding how the zeitgeist is shifting and how, perception is reality, and it shapes it in a meaningful way. There's a reason why 60/40 has become, in the minds of so many investors, the established portfolio, right? This cure-all, be-all, because the formative years of most allocators have been spent in the mother of all bull markets for the 60/40 portfolio. So you have to contend with all that, deliver a message that's, effective, but also punchy enough and salient in their minds so they can understand that there might be a problem that you're trying to solve, and that there's a reason why you're trying to create a portfolio that's structured that way. I wonder if we might get a little bit into the specifics. I know you guys recently launched a fund, DYMIX for short, or DYMIX, and maybe this is a moment, probably should have done this 40 minutes ago, but to let everyone know or remind everyone that none of this is going to be investment advice, even though we are talking about a specific strategy that Brad and Matt are managing. But we'd like to get a little bit into the specifics of this, because we've talked about approaches, we've talked about investment universes. You guys allocate to third-party managers, you allocate to some of our funds, but we would like to know a little bit how you guys attacked the problem in as much specificity as you guys are willing to go. So maybe let's set the stage. What's the strategy like? What's the investment universe that you guys are using?
Well, Brad, why don't you sort of tell the story, the genesis of how the fund, the ideation for creating the fund came up? Because I think that's a good story and tease it up.
Yeah. So, I mean, the strategy is, so the mutual fund we launched August 1st, the ticker symbol is DYMIX. It's the Dynamic Alpha Macro Fund. And we created it because, we were doing the OCIO, and I have had past investments in hedge fund strategies that did very well. And basically through the connections of the OCIO, diving into the operatings of mutual funds, we had the opportunity to say, can we turn this, great hedge fund into a 40 Act available fund? So it was a few years ago, we presented the hedge fund strategy to a group of advisors, and the advisors loved the hedge fund strategy. It is non-correlated. It was a global macro fundamentally managed strategy by a team of economists, right? So different, different than a quant strategy, different than trend following, not a black box algo inside another black box algo inside another black box algo, right? It's totally different. And the feedback we got from advisors was, this is wonderful. We love it. What's the ticker symbol? And the answer was, well, there is none. It's a private placement, hedge fund structure, accreditation status, a lot of hoops to jump through. So, so what we did, it took us some time, was to figure out, well, how can we turn this strategy into a 40 Act fund available to individual investors? And what we found is by actually marrying that strategy with equities, right? And, you guys coined the term return stacking, right? So there's definitely some of that in there as well. Whenever you utilize futures, a very efficient vehicle, you get some of that return stacking. But we married, long only U.S. equities with this global fundamentally managed macro strategy, that the correlation between the two was near zero. And what we found is that by marrying the two together, the was the saying, the whole is greater than the sum of the parts, right? And that's what we found. And the reason is because of the dynamic alpha, as we coined it, right? When one's zigging, one's zagging, and we have that opportunity to rebalance just in time for the one that's zigging to zag, and the one that's zagging is zigging. If you follow the zigzag theoretic,
skis and bikes
logic there, it's that rebalancing alpha, the dynamic alpha, being able to truly benefit from non-correlation, and we're able to do it in one fund very effectively and make it available to anybody and everybody that without accreditation status, through a simple ticker symbol. We have a very simplistic view. I jokingly call it peanut butter and jelly, right? You love your peanut butter, it's great. You love your jelly, it's great, but you move it together and it's even better, right? And that's kind of what the strategy is. It's two great things married together equal the whole is greater than the sum of the parts. So that was kind of the precipice for it. And it's
and to be like, just to go into a little bit of the weeds here, the hedge fund strategy on its own uses a decent amount of leverage. It can be a little bit lumpy, and so owning it by itself is a tougher own than being able to own it with equities. So again, not only do we get that benefit of being able to capture the non-correlation by rebalancing between the two, which if you think about it, if you're a hedge fund investor, like, how would you even be able to do that unless the manager is willing to do it for you? Because at the end of the day, you might need to give 60, 90 days notice to get your cash out. So unless you can predict the future of what's going to happen over the next 60 or 90 days, you're never going to know exactly whether or not you're actually selling high and rebalancing. There's just too much of a time lag between the two. So it's worked out rather nicely. We're excited for it. And it's been received pretty well.
Not to mention the behavioral bias of people.
Yeah.
People just, I mean, let's going back to our other conversation, the idea of, the advisor calling the individual and making this trade, the time lag, the probable cause of the individual asset owner saying, well, no, let's just ditch the one that's down and keep the one that's up. Let's eschew diversification. I mean, we were talking earlier, I think it was you, Matt, that mentioned, some of the you should have something lagging in your portfolio. If it's all going up, you're not diversified. It's not a bug. That's the feature of diversification.
Right. It's supposed to happen that way.
I want to jump up and down. Yes. There are things in your portfolio.
And that's what gives you that opportunity to sell high and buy low, right? Buy low, sell high. So we take that emotion out of it within the fund, and we'll sell equities and we'll buy the futures, or vice versa, right? And that the understanding behind it, but one of the things we really like about the strategy is that it is fundamental, almost story based, right? Within the global macro strategy. Sometimes alternatives can be hard to understand for investors, right? Trend following or managed future.
Intuition, there is no intuition. But
that
keep
is
going.
the beauty of this.
Circle back. We'll circle back to that. Keep going.
Yeah. So one of the examples I always like to give, an example of we'll call it a hypothetical trade, right? Was in cocoa powder and cocoa futures. So a number of months back, the went long cocoa powder because of a El Nino weather pattern that was headed towards the Ivory Coast, and the local farmers in the Ivory Coast were already not applying the fertilizer well, right? So poor fertilizer application, bad weather is coming. That's going to drive up cocoa prices, right? So that's you could think about that and say, yeah, that makes sense, right? If the weather's going to be bad, if they're not using fertilizer appropriately by the application, that's going to drive, the crop isn't going to be good, and then the price is going to go up because the supply, basically a supply and demand imbalance, right? If you think back to Econ 101 that most of us had, I would think, you think of your demand and your supply curve, right? And when something gets out of whack, there's a supply-demand imbalance. What eventually happens is you get back to equilibrium, right? And that's kind of what the strategy attempts to do: take advantage of price, demand-supply imbalances, and because the strategy is story-based almost, right? That cocoa example, you can hear that and say, that makes sense. And then we would say, well, what does that have to do with Jerome Powell today? Or what does it have to do with Tesla's earnings yesterday, right? Maybe they should have been eating more chocolate and been a little happier. I don't know, but
the mocha Java trade, long cocoa, long coffee, long sugar.
Hey, it can work, right? And it's a diversifier. It's a good diversifier. And sometimes somebody, again, in the back of the room will raise their hand and say, but Brad, we can just buy Hershey's or we can just buy Nestle's stock. And that'll give us the chocolate exposure, right? And not really, because if you think about it.
Don't get me started.
Yeah, because who's going to buy the raw cocoa?
Let's disassemble that, shall we?
Yeah. As I
what's the number one
one
criteria? Is it making the chocolate bar, or is it delivering the chocolate bar, delivering the cocoa via oil and gas and natural gas at the production facility and the production and then trucking it to the places that it needs to be trucked? You thought it was a cocoa thing. Oh,
yeah.
Well,
You thought they owned cocoa farms, huh?
Yeah. What was the distribution contract like? I mean, let's go through Coca-Cola and sugar and the Coca-Cola contract between Warren Buffett and Coke Distributing.
Not to mention that you're capturing a portion of the commodity, but what you're really exposed to really is equity beta, right? Yeah. You're exposed to the equity markets, and then you're getting a little bit of the upside. It's the whole thing when you're buying a miner as opposed to buying the underlying metal. Yeah. Or an oil and gas company versus buying crude oil or gasoline futures or any one of those. So is the hedge fund strategy, is that the universe, is that a futures-based universe exclusively?
Yes.
100% futures-based. Yeah. Global, macro, long, short. Generally,
how many futures,
if I'm not mistaken,
contracts are we talking?
45, I believe, total is the universe, if I'm not mistaken. Mm-hmm. I know our marketing deck says 40 plus, but I'm pretty sure it's 45 is the number.
Yeah. You're monitoring the health of the markets. I mean, since we have cattle as well in part of our marketing materials, but they have recently been benched because liquidity just wasn't there. So these are things that you have to consider. So you give people a range, but it's never going to be a precise number.
Right. You might have two names in there that you know it's very unlikely you're actually going to touch. And I mean, again, I don't want to get too much into the holdings that we have had, but it tends to be a pretty concentrated strategy. It tends to be 3 to 6 themes on that side that are operating at one time. And they all tend to be really, the return stream overall has been non-correlated to equities. Let's put it that way, right? But the individual plays on any given time might look more correlated or less correlated. So it's to our conversation earlier of thinking about, is it the asset class or the underlying asset, or is it the strategy or the manager? And this is one of those situations where it's really a little bit of both, but mostly let's look at 2 return streams and see how they relate to each other and whether the combination of those 2 can lead to something really great. And I think
it provides a little bit more opportunity for some of the intuition to build, right? I think we were talking about that earlier in this, and there's just not, if the equity sleeve of this portfolio, if the S&P is up, it's likely going to be up. If the S&P is down, it's likely going to be down. And I think that is a little bit of what people fall prey to in the benchmarking side of things, is that, I see the market, stocks were up, bonds were down. I kind of have a sense of whatever I did, whether it was value or whether I was capturing an extra 60 or 100 basis points trying to capture momentum. I kind of know how I did. Now transition to 45 different markets, long or short, across various sectors. You don't have any intuition.
Don't worry, Brad's out there calculating daily what our NAV is going to be at the end of the day.
Brad has intuition.
Where are we at?
I have a spreadsheet.
Brad has intuition.
But to your point, that the universe that we're in, and sort of with your guys' fund and a lot of the other funds that people have used or in the return stack models you guys demonstrate, like it's great to see at the end of the day that all of us are in different places, right? Some of us may be directionally the same. Some of us might be directionally opposite. The magnitude is certainly different of those returns, but it goes to that same idea that, like, once you're indoctrinated in this idea of owning non-correlated assets, it's beneficial to add more of them, because in general, there's no one that's going to be representative of them. It's not like owning a total return bond fund and knowing that it's going to give you generally the same directionality as every other total return bond fund, right? Yeah. It's a completely different idea. And I think that's one of the reasons why advisors struggle to do it because so long they've been pitched, find the best in class fund and use that for your sleeve. And that's just not applicable in our world.
Correct. And it's a challenge. It's a challenge, I think, that we attempt to try to provide narrative and information around in order to help facilitate the intuition, to help facilitate the learning and understanding so that you can have that long-term ownership and long-term rebalancing that creates the tailwind for the asset owner, enhances return, decreases risk, increases the risk-adjusted returns, and provides a better outcome at the end of the day for the asset owner as they're in withdrawal of their portfolio or whatever it is that they're trying to achieve. And it's critical. And so I joke around about benchmarking. I joke around about the tracking error as we have today. And we like, oh gosh, if we're all robots. But I suppose that's our opportunity. I mean, we should embrace the fact that the world is not all robots, and that therein lies the opportunity for people to make mistakes. And when we're talking about alpha, we're talking about capitalizing on the mistakes of others. And so as much as, I'm trying to push people in this direction, I don't want too many people in this direction. I want just enough people in the direction so we can all, profit enough for our particular tribes who happen to embrace the opportunity that has presented us with this. So, I love it. Over to you.
Yeah, and that's the beauty, right? It's because there's different methodologies, and as Matt said, I mean, the performance has been uncorrelated, right? We compare our performance to your performance to some of the other ones that we love and follow and recommend. It's kind of fun to look at the end of the day and wait an hour and a half after close and say, okay, how did everybody do? And it's with some of the ETF products, it's a little easier because they're priced every, as you go, so to speak. But they're really all non-correlated. Even managed futures trend followers can be non-correlated amongst themselves, right? And given that we're a fundamental global macro strategy, that the strategy itself is different. You guys might be long cocoa as well, but for different reasons, right? And that's
short
okay.
it. I don't know.
You might be short it, right? And we might not have it at all now. So it's different approaches, right? It's kind of like directions, right? If we're all trying to go to the Costco down the street, but I'm going to make a left and you're going to make a right, we might get there at the same time. It's just I might hit some potholes that you don't hit. You'll hit different potholes that I don't hit. And the beauty of investing portfolio is we're all in the same car, right? And you might hit potholes at different times, and then that helps create that kind of evenness out for the investor's experience. And look, that's non-correlation doesn't mean negative correlation, right? There'll be times when our type of strategies are up when the market's up, and we might be down when the market's up, and we might be down when the market's down, right? It's
the whole point is that the correlation against the benchmark is not static. It is rolling up and down over time. That's definitely one of the things that we put forward as one of the values of our strategies, is that sometimes there's a bull market in equities. Oftentimes there is, and we can participate in that. When that happens, we're going to have a higher correlation to the SPOOs or to the NASDAQ. But then there's going to be moments when it doesn't really behoove us to be in equities as much, and that correlation will dip closer to zero. And then more recently, we've had positions where we've been short the equity markets, and so our correlation will dip into negative territory. So it's about, but I can't help. I want to dig deeper. I want to know, you guys are talking about on the alpha strategy. Positions can be as concentrated as maybe only having 3 outstanding positions at any given moment in time. It can be as many as 15 or 16 out of that universe of 40. Oh no, plus
it's going to be like 3 to 6 themes. I mean, total investments, I suppose. Yeah, yeah. It's pretty. It's a concentrated strategy.
You've given us just enough to keep the curiosity alive. So I mean, I want to dig a little deeper. You say narrative based. It's storytelling. There must be a little bit more method to that madness. I mean, you guys are probably looking at different signals. How much can you guys share? How much are you willing to share? Give us a little bit more of the goods.
It's a fundamental approach. So, I mean, it's the same funnel you've seen 1,000 times, right? You start with the entire universe and you start filtering out for areas where you might see imbalances for one fundamental reason or another. And then he starts doing more technical analysis to find out whether or not there's opportunity from a price momentum standpoint. So there is an aspect of technical, but it's all driven at a fundamental supply and demand imbalance is where everything comes from. So it's that same idea, taking the universe of 45 potential investments, finding the opportunities that might be there, refining those down, and then weighting in what he's most confident in versus least confident in across those themes. So I mean,
are those commodities? So are these markets all commodities? Do you have any equity futures, bond futures?
Yep.
Oh, you don't have them.
Yeah. Yeah. So, I mean, he can be short the market while we're long the market. He could be, short bonds while we're in the portfolio, whatever. I mean, he can do anything he wants on the long and short side in any of those markets.
And how does sizing take place? Are you guys conviction sizing? Is there any kind of inverse volatility?
So this is going back to your return stream discussion. I'm sorry, Brad, if you want to take that.
No, go ahead.
Yeah. Going back to the return streams, like when Brad came up with the idea and did all the testing on this, it was taking the return stream of his program versus the return stream of the equity bucket that we use, right? And blending those together. So we just let him run the same strategy at a slightly lower leverage ratio than he would run if you were running it straight as a hedge fund. So that's really the only difference.
Yeah. So to answer, I do know, I mean, there is some conviction sizing, right? So the stories, as I say, or the fundamental cases, the demand supply imbalances, the strongest convictions will have a stronger weight, right? And the positions there is diversification within there to try to, create some non-correlation even within those future contracts and the position sizing and the themes. And the cocoa example, is one example, but you might be long gold for totally different fundamental reasons, right? And
it's an example. The key is that's an example.
Those are examples. Those are examples, right?
And we use that one because the story is so salient, right? Like it's such an easy story to tell, right? Like if he were long gold, that's a much more difficult situation to tell because the supply and demand really isn't. It's not necessarily supply and demand in the traditional sense of people aren't buying all this jewelry. Like that's not the cause of gold going up or down at a given time. I mean, I guess it's part of it, but there's many other issues there. And so some of those stories are harder to tell, but we try and find a couple of themes that are going on in the portfolio that are much easier to tell, because if we can get those talking points in the hands of advisors to tell their clients, it gets them a little bit more comfortable with sort of understanding what's going on with recognizing that the individual investor is going to have a hard time understanding how these strategies actually work under the hood. But if you can give them some ideas about like, hey, that cocoa example, like how is that going to be correlated to your regular SPY holdings, or your ag holdings? It's a totally different bucket and they can kind of understand it a little bit.
Well, I think that's so key, Matt, is that the market participants in the cocoa market, in the grain market, in the SOFR market, they are different participants than are in the S&P 500 market. They have different supply and demand constraints and opportunities. This is what provides the diversification. This is what provides those. And there's different market dynamics in wheat. Is it winter wheat? Is it, spring wheat? Like there are a number of different things occurring which provide the opportunity for diversification, just like the individual securities in your portfolio, but they're not dominated by this one overarching equity beta component. That's the key to providing robust diversification. That's the feature. It's not a bug, it's the feature. Anyway, this is important to understand that key concept, and then the managers looking for the potential for supply and demand dynamics that will be out of balance, that will require a new equilibrium. That new equilibrium results in a new price from point A to point B. Mm-hmm. They would like to be on the right side of that transition from point A to point B.
Absolutely.
Exactly.
Yeah, and it's different return drivers. Again, it's in the strategy, in the fund, there's multiple drivers of return, and there will be times that we're wrong and that didn't drive the right direction. But that's why there is diversification. That's why there's sizing. That's why there's risk management on that side, right? And but that again is diversification, right? It's not everything is going to work, but that's why you have different drivers of return, as we say.
And then when we talk about the beta side of the portfolio, we talk about U.S. equity beta. Is it global? Do you guys? It's U.S.
It's
all
US.
U.S.
I mean, yeah,
it's all U.S. We do break it down between a balance between growth equity, kind of core blend equity, and then dividend focused equity, just to kind of get a good balance between the two and allow us to kind of rebalance even with inside the equities. And when flows are coming in, it allows us to kind of add to, maybe dividend stocks are not doing as well as growth stocks or vice versa, right? And then we can kind of dynamically add to the areas that can be most beneficial over time by that rebalancing effect. But the goal is to kind of keep it a balance. We're not making an over bet and say, yep, tech stocks are going to be better or dividend stocks are going to be better. We try to keep it a balance, an even balance between the two, and just rebalance accordingly.
But if you think of the two halves of the portfolio with the macro strategy over here and the equity strategy over here, the big correlational benefits between those two. But even inside of the equity bucket, we do have a little bit of benefit between the growth side and the value side, right? So whether it's a value dividend strategy or something like that, if those are down, we can add to those a little bit more to bring them back up or to try and average down our costs there. So there's a little bit of diversification benefit there, but it's really just allowing us to have a couple of extra tax lots to potentially play with at the end of the year, or rebalance between if there's the opportunity to do that at some point. If we got some, like had we started January of this year, our growth stuff would have been up 20+%. And our value stuff's going to be flat, so there would be some opportunity there to sort of load up that value side. Again, not knowing whether or not it's going to be beneficial or that trend continues where growth just continues to kill value. But at the end of the day, again, buying things cheaply generally works out. So yeah,
love it.
Makes sense.
Love it, guys. We've given us an hour of your time. I think it's been an amazing hour, and I want to leave people wanting more. So I want the opportunity to circle back with some more stuff.
Absolutely.
So it's dynamicalphasolutions.com, right? It is
and if,
Brad, Barrie, Matt O'Brien. What are your social media?
If you want to share the screen,
sure.
Annie can share the screen. So there's our contact information. Given that it is Halloween and the theme was Fear No Market, we do have, that's why my jack-o'-lanterns back here.
Love it.
We do have lots of dynamic alpha solutions and dynamic alpha macro fund branded M&Ms. So if anybody wants some Halloween candy, please email us and we'll be happy to send them. Otherwise, Matt and I are stuck eating all these M&Ms. But feel free to email us with questions. Again, dynamicwg.com is our main website. Brad at dynamicwg.com or Matt at dynamicwg.com is the best way to get a hold of us. We're on LinkedIn. And please email us, mention M&Ms, and we'll send you a bunch.
And fear no market.
Great.
And fear no market.
This is great, guys. Thank you for coming. Really enjoyed the conversation, and we'll have to get you guys back for an update on the strategy and how everything's going on your end. So thanks again, everyone, for watching. Please smash that like button, subscribe to the channel, share so we can get great guests like Brad and Matt back on the show.
This podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.